Live. Good afternoon to all our speakers and delegates who have joined us for the second Windaba 2020 webinar. I'm Neil Piper, the Head of Content for Messi Frankfurt, South Africa, and I'll be one of your hosts today, and I trust you'll find the webinar engaging and very thought-provoking. The webinar will be addressing the very topical and important topic of refinancing of renewable energy projects in South Africa. We've got a full lineup today, and really we've lined up a panel of great speakers who are going to share their thoughts on the subject matter. And on that note, it gives me great pleasure to welcome the speakers for today. First up, we've got Ntombifuthi Ntuli. She's the CEO of the South African Wind Energy Association, SAWIA. We've got Elsa Strydom, Head of Infrastructure Finance, IPP Office, the Department of Mineral Resources and Energy, South Africa. We have got Daniel Zinman, Senior Transactor for RMB. Jason van der Poel, he's a partner of Webber Wentzel. Mark van Wyk, Unlisted Investments at Mergence. And finally, Henny Hanekom, Financial Manager at Noblesfontein Wind Farm. Welcome, and thank you all for your efforts in preparing for today. I know there's been a lot of back and forth and making sure that your presentations are fantastic for all our delegates today. So just from all of us, thank you for all of your time. The agenda for today, ladies and gentlemen, is going to be as follows. We are going to start with Ntombi, and then we're going to go into a speaker session hosted by Elsa. We are going to go into a speaker session hosted by Daniel, then Jason, and another speaker session, Mark van Wyk, Henny Hanekom, and then we're going to go through a Q&A hosted by Ntombi. Please send your questions through. Ntombi will be reviewing those questions, and at the end of the seminar, what we'll do is we'll answer some of those pertinent questions. And what we'll try to do, if we can't get to all of the questions today, we will try and answer your questions after the session, and you'll get a recording of the session today post-event with the presentations there. So I've been through the agenda, and now it's my pleasure to welcome Ntombi to give you a welcome.
Thank you, Neil. Good afternoon, everyone. It gives me great pleasure to welcome you to the second in the series of Windaba webinars. We started with the series last month, and we're hoping to run with the series until our main event in November. Today, we are going to talk about refinancing, which is a very topical subject. And this comes off the back of the request from the IPP Office, from the Department of Mineral Resources, for IPPs to consider refinancing the projects. I'm no subject matter expert, and we have a great panel of speakers to give us insight into what are the implications, what are the positives, and what we should look out for on the topic of refinancing. So without further ado, I'm going to hand back over to Neil to direct the program. Thank you so much for joining us.
Thank you, Ntombi. Just to let you all know, we have got 180 people on the session so far. We had many, many more registered, so I'm sure they're going to join us now. But next up, and our first speaker for today is Elsa. Welcome, Elsa. Over to you.
Thank you, Neil. It's a great pleasure for me to be here and also to speak to this refinancing initiative of the department. I think as renewables and the contribution that renewables and the projects that we've managed to put online, the investment that we've brought about in the past since 2007, for me, it really is a good thing to try and see how these projects can further contribute to South Africa and also reflect a participatory approach to South Africa and the challenges we currently have. So basically, let me just start by giving some background to this refinancing initiative. As Ntombi said, the minister, both the ministers of public enterprises as well as the minister of mineral resources and energy, last year met with all the IPPs. There was a big come together meeting in September, and basically the purpose of that was to brainstorm how these operational IPPs could contribute to the lowering of the wholesale price of electricity, but as an input into the economy. So it's basically as all of South Africa and these renewable projects as part of the bigger electricity generation sort of a community coming together and saying, how can we contribute to reducing the wholesale price of electricity? So as an outflow from that meeting, that big meeting, there was the task team that was put together and basically included representatives from BASA, the lenders, and also the department and ourselves. And we basically started working through what can be done, what is all the alternatives that could be put on the table, right from things like extending PPA terms to the new bid rounds. What can we do and how can we participate in this process with the objective of stimulating the economy and passing the tariffs back to the consumer. The outcome of that process was a report where the task team concluded that the best way for us to do this is through a refinancing initiative, and that is also a refinancing is also something that the market should be quite comfortable with, and it's a natural progression as part of the process. And from that reason, the task team recommended that the minister approves this refinancing initiative. We can move on. So basically, the initiative was then approved by the minister, and the key principles that has been approved is basically that the participation will be voluntary. It's on a voluntary basis, that there will be a sharing of the refinancing gain at a minimum of 50-50, but in circumstances where applicable, a higher percentages can be offered or negotiated. That the outcome of this process will not lead to an increase in the contingent liabilities associated with these projects, and that the benefit will see its way through to a tariff reduction over the term of the PPA, and that it is an urgent initiative and it has to happen as soon as possible. So the ministers also mandated the IPP Office to run with this process, as it is an outflow from the Section 34 framework under which these projects were procured, and that as part of that process to ensure the standardized preparation of the refinancing request, but also the assessment on our side, we will issue a protocol. This is also a war room initiative in the sense that the support of the other key stakeholders like NERSA and ESCOM for timeliest turnaround of requests has been solicited, and we will report on a regular basis back onto the war room on this. It gives me great pleasure to say that the refinancing protocol has been developed and approved, and that it is actually available as from today. It has been sent out to all of the relevant IPPs, and it will be available on our website shortly. The refi protocol aims to provide a guideline to standardize the preparation and also the assessment. It basically clarifies as to what we consider to be a refi. It provides further information about the kind of information that needs to be submitted as part of your request. It clarifies the basis on which the calculation will happen, how we will assess the impact on contingent liabilities, basically the tariff reduction, how that should be dealt with. It deals with issues around discount rates, and it basically also deals with issues around the cost of the parties, and also the assurances that we require as part of this process, and some indicative timelines, as we fully understand that the timeliest turnaround process around this is critical to have a good outcome. If you can move on, Neil.
Okay.
Okay, so I think in terms of the implementation of the initiative, I just wanted to indicate the process we followed to now, and also just what is the key next steps. So in the end of May, we sent out an invitation to all the IPPs for them to indicate on a non-binding basis, to indicate to us if they intend to refi, and what is their estimated timeframes or timelines for them to do this. We also had many engagements with the IPPs, as well as with stakeholders and other interested parties, the lenders, explaining what we want to achieve and answering some questions that they might have had. The response that we received at the end of May was very positive, and it's very encouraging. Of the 64 operational IPPs, at least 70% have responded in a positive way, and most indicating that the timelines is anything between 4 to 6 months. There are those that are more ready than others, and that were already previously anticipating a refi or planning a refi, and will be ready to submit by the end of July. We really hope to show some good progress on this by September, and we will regularly report to the War Room on this. We do, however, understand that the current situation, the COVID-19 situation, etc., does impact the circumstances, and it could also impact timelines. I think what we need to understand is, from the IPP office and the department's point of view, we really want to achieve the best possible outcome of this process. So we do take that into account in terms of timelines, etc. So the key next step was to issue the refinancing protocol, and as I said, that will be concluded at least by tomorrow. And also we will be issuing a standardized template, which has been developed together with our advisors on the program, which will basically be a sort of template that indicates what type of information the IPP needs to submit as part of their refinancing request, and how the assessment will be undertaken. We are committed to continued engagements and with all stakeholders. And I think the big issue that we really want to stress here is just that this is a very key initiative for the department and for the IPP office, but also for all participants. There are new rounds coming, there are new procurements coming, but there is a big eye being cast back to the IPPs that we currently have, and also how they contribute and how they will want to be part of the future going forward. And as such, there's also regular reports on the outcomes. As an introduction, that's basically something from me. Neil?
Great. Thank you, Elsa. That was very enlightening. Next up, we have got Daniel Zinman. He's going to be talking now to you guys for around 10 minutes. So over to you, Daniel.
Thanks, Neil, and thanks, Elsa, for that introduction. It was an excellent segue to some of the issues that I want to talk about, and also thanks for sending out the protocol document a couple of hours before this webinar. So we all had a bit of homework to do just before we got on. Just to be clear, the slides that I prepared were prepared last evening and sent out last evening to Neil, so they may be slightly outdated, although I think that Elsa and her team have done an excellent job in managing the market's expectations. So in a broad sense, it was pretty much in line with some of our thinking. Next slide, please, Neil. So I wanted to delve in first to some of the financial parameters around the refinancings, and Elsa alluded to them. And I thought maybe we could just delve in a little bit more deeply into them, and then that will then influence both how banks look at these refinancings, and secondly how project companies and shareholders themselves could look at these refinancings. It's probably worth just saying that obviously we're very excited about this. We think it's long overdue and an exciting opportunity for the market. So there are really two items I wanted to touch on in terms of the financial parameters. One is the concept of the contingent liability and how banks think about that. And the other is the concept of the refinancing gain. So in terms of the contingent liability, as Elsa already mentioned, one of the core tenets of the protocol document, and was, as was explained to us prior, is that any refinancing cannot result in an increase in National Treasury's contingent liability associated with a specific project. So essentially what that means is that in the event of buyer default under the PPA, which then leads to termination and a termination payout from National Treasury, there's a profile of what that amount and how, I guess, the size of that amount and how much that would be paid over the course of the life of the project and the PPA. And that profile cannot be exceeded as a result of the refinancing. So in calculating that termination payout, which is in turn the contingent liability on National Treasury's books, it really, in simple terms, is the outstanding debt at the project company at that particular time, plus the NPV of all the flows to shareholders for the future discounted at the appropriate IRR, less any cash in the project at the time, hedge break gains, etc. So it's essentially, if you want to break it down in simple terms, it's basically outstanding debt and the NPV of the equity flows in the future. So in terms of when you consider a refinancing, you need to think about, well, is it going to increase that contingent liability? And if so, how do you then go about changing the terms of your debt? Because if you make your debt longer, if you put more debt into the project, that's obviously going to have, because it's going to change one of those components, it's obviously theoretically would have an impact on that contingent liability. So how are you going to effect a refinancing and change the terms of your debt without increasing the contingent liability? So the answer to that question is it's actually very possible to do that. And as I explained, and perhaps, Neil, we can go to the next graph to show this graphically. It really is a debate between lenders and shareholders of the project around the proportionate sharing of that termination payout in the event of buyer default. So what we did in these graphs, and this is just a hypothetical early round REAP project. And if you look at the graph on the left where there's just blue and orange, essentially what you've got there is a cumulative calculation of the value of the debt and the outstanding at any given point in time, and the NPV of the equity flows at that point in time. And so it really is the sum of the blue and the orange, which gives you a total, which would be the termination payout at any given point in time, and therefore the contingent liability that sits on National Treasury's balance sheet. So if you look at the graph on the right, what we've done is we've taken a hypothetical increase in the quantum of debt and also extending the tenor of debt. And as you can see, what really happens is that you've now got this green overlay above the original debt profile. Now, what we've done here is the way that banks would want this to work, and the only way that they would be prepared to take this risk, is to say to shareholders of the project company, we're very happy to give you more debt, and there are obviously some bases upon which we'll do that, and we'll touch on that just now. But effectively, if we ever get to a buyer default, which leads to a termination payout, lenders would then want to effectively eat into shareholders' portion of the termination payout. And provided that shareholders are comfortable with that arrangement between them, then there's absolutely no need to increase the contingent liability on government's balance sheet. So, and from my experience, and certainly from speaking with with both shareholders of project companies and project companies in the market, that seems to be something that almost exclusively they're prepared to accept. So I guess that's also a function of the fact that they think that that buyer default and the risk of a termination payout is obviously quite low. So that's just an interesting graphical representation of what we're trying to achieve. Maybe next slide, please, Neil. The next point is really around the refinancing gain, and this is one of those big topics where there's a broad understanding of how it works, and clearly with the protocol document that came out today, a lot of those of the nuances and the mechanical inputs that need to be used in that calculation have now been clarified. But essentially, it's relatively simple. All you're doing is you're taking what the net present value is to shareholders before the refinancing, then overlaying in your financial model the new debt, the new terms of the debt, whatever they may be, and then seeing how the NPV to shareholders increases. And then, as Elsa mentioned earlier, what the IPP Office or the DOE want to do is effectively share in half of that benefit, at least half of that benefit, by reducing the tariff accordingly. So what you would then do is, and I've used the example of 150 million. So let's assume that there's an NPV benefit to shareholders that results from the refinancing as I said, of 150 million. What you would then do is you would then reduce the tariff until such time as that NPV benefit is halved. And that then transfers the benefit of the refinancing, or 50% thereof, to the IPP Office, to the DOE, ultimately to the consumer, through a tariff reduction over the remaining life of the PPA. I've gone into a little bit more detail on that slide, but you can read it. That's essentially how it works. So just looking around a refinancing, and this is quite nuanced, and potentially for some of the shareholders on the call in projects, this is something that they obviously are thinking about, is that there are different drivers for refinancing, which are different for different project companies, different shareholders, different types of shareholders, and we've listed them here. So do you have shareholders who want an increase in their yield and don't necessarily want cash out now because they have a refinancing risk? Or are there shareholders who actually want cash out now? So there's an interplay between those two. Does the project company and its shareholders want to go what I call the whole shebang? So do a refinancing, approach the entire market, restructure every element of the debt, new financing docs, etc. That obviously has a cost implication, it has a time implication, but can probably lead to more benefits from the refinancing. So there's an interplay there to think about. As I said, simpler versus more complex, lower transaction costs versus higher transaction costs. And also, is your aim here to maximize the tariff reduction or maximize the NPV benefit? So there's some drivers there. And as I said, we've seen this. They're different shareholders will have different drivers, and different project companies themselves will have different aims that they want to achieve. So we've just listed some there. Next slide, please, Neil. And then here's really, and it sits on a spectrum, and these are not meant to be an exhaustive list of potential options available for these refinancings, but it's just some thoughts to put to the viewers and the listeners. But and I think 2 points. One is, this isn't intended to be an exhaustive list, and secondly, a lot of these options are not necessarily mutually exclusive. So you can do combinations of these two. So obviously the simplest option, I suppose, is to do absolutely nothing. But the next simplest option is really just to go to your incumbent lenders and say, well, times have changed. The project's been operating for X number of years. It's operated, at or better than what we thought. Debt margins have come down in the market as REAP has become more established. Can you just reduce the margin on your debt? Simple, easy to transact, and that's kind of one end of the spectrum. Other options include increasing the quantity of your debt. As you can imagine, and I'm sure those who are involved in project companies will know this, typically your debt financing ratios are tightest at the front end of the project. So because these deals have now been operating for a considerable period of time, there's often a lot of fat in those margins. And secondly, margins as a requirement from debt, as the assessment of risk has come down in REAP, enables you to really gear into those ratios now. Likewise, with increasing the debt tenor, the requirement for tails on the PPAs is different now than what it was in the early rounds of REAP, when it was 4 or 5 years. Now it's 2-3 years. There are structural changes you can make, as I mentioned there, number 4, converting JIBAR debt to CPI debt, or vice versa, which is probably a little bit more complicated and costly, but that's another opportunity. One aspect that I think is certainly mentioned in the protocol document that was released, and Elsa alluded to it, is the replacement of reserve accounts with contingent facilities, which can then release cash to shareholders or for other uses in the project, which is also a form of refinancing. You can replace your subordinated debt with senior debt, because again, there's more space to gear into. Or you could even introduce junior debt to replace equity that was in the capital structure originally. And then lastly, and I'll just end with this point because I think I've run a bit over, but we also think there's quite a lot of value in restructuring your risk mitigation strategy. So whether that's a hedging policy, whether that's, because rates have changed materially since when a lot of these deals were closed, there may be an opportunity, albeit potentially with a refinancing loss, to restructure some of those hedges and potentially relax a hedging policy that may now look to be overly punitive relative to the risk and the space and the ratios that these deals have now have now shown to bring to bear. So there are as I said, there are a whole suite of options that project companies should be considering when it comes to refinancing. Thanks, Neil.
Daniel, thank you very much for your insights. Just to let you all know, we've got 222 participants in this webinar today, which is really good. It's obviously it's a hot topic, and the timing couldn't have been better. So well done to Natombi for selecting this date. You did well. But next up, we have got Jason van der Poel. He's going to be addressing you now. So over to you, Jason.
Thank you very much, Neil. Thank you, Elsa, and thank you, Dan, for your introductions, which are extremely helpful. Elsa, also thanks to you and everyone at the IPP office for circulating the refinancing protocol earlier today. I think everyone was waiting for that with bated breath. The drivers for IPPs to do refinancings will largely be commercial. I'm a legal guy, so I think I'll be able to keep this quite brief, but there are some important legal principles to bear in mind in embarking on these refinancings, which I'd like to touch on. By way of overview, I'll speak to what we know about the refinancing process so far. I don't need to say much because Elsa and Daniel have already gone through a lot of that. We'll review some of the history of the program, discuss some of the key legal considerations, for example, the key clauses in the implementation agreements and the finance documents, and draw a couple of conclusions. So step one, Neil, if we move to the next slide, we have the letter that was sent to all IPPs on the 30th of April 2020. Elsa alluded to this already and some of the background, setting out the key principles for the refinancings, including no increase in the government's contingent liabilities. That in particular refers to clause 12 of the implementation agreement, which speaks to the termination payment for government default and what government will have to cover, debt and equity, less certain specified costs. A very important principle from a legal perspective is that participation in the refinancing program must be voluntary. We have seen examples around the world of where governments have forced IPPs to take mandatory reductions in their tariffs, and that has ended in voluminous arbitration and dispute. And it's very encouraging to see that the participation in this program is entirely on a voluntary basis. Another of the principles is the 50-50 gain sharing, and the refinancing protocol goes now into some detail about how that is to be achieved. And then the outcome should be a meaningful reduction in tariffs over the remainder of the PPA term. So the IPP office also in that letter sets out some timeframes for achievement of the refinancings. Neil, we can move to the next slide. The refinancing protocol itself is well structured and a fairly succinct document. Thanks for that, IPP office. It talks about what constitutes a refinancing. And one of my early observations is it includes some things that, like the release of LC letters of credit or cash balances and certain other changes in types of debt, that the current refinancing clauses in the rounds 1 to 3.5 refinancing clauses, that they don't cover that. So I'll look at those clauses a bit later, but the refinancing clauses allow for refinancings as long as they don't increase the tenor and the quantum of the debt. And so refinancings that fall into those categories ought in principle not to be subject to the same level of scrutiny as refinancings that do increase the contingent liabilities, that do increase the quantum and the tenor of the debt. The refinancing protocol also looks at the key principles that Elsa and Daniel have discussed already. It talks about the process for gaining consent to refinancing notices. It talks about the process, method, timing of calculating, sharing and paying of refinancing gains. It speaks just specifically to the use of the base case financial model, and it speaks to how to calculate the NPV. It talks of various documents to be submitted by IPPs and lenders in preparing for refinancings. It also talks about indicative timelines and audit rights. Neil, we can move to the next slide. Just by way of history, the IPP procurement program in South Africa is a really well-structured program. It's received a number of international awards. There's part A of the RFP, which sets out various rules and requirements. Part B, which are qualification criteria, so hurdles over which the IPPs needed to jump in order to gain access to the program in a sense. And then part C of the RFP is the comparative, the evaluation criteria, which are twofold: price and economic development. And therein lies the entire economic development package around ownership, management control, job creation, local content, preferential procurement. So a lot of positive good coming out for society through the IPP procurement programs. But the slide speaks to the detailed process that IPPs have gone through in participating in this program. Neil, you can move to the next slide. This is also a listing of the prices extracted from a report from a couple of years ago, which just shows the price reduction across the different rounds. The principle being that the early rounds, there were in the early rounds there were risk takers who were rewarded for taking that early risk. And as the rounds progressed, you see that the prices very steadily reduced for wind, solar PV, and concentrated solar power also. So from wind farms at 114 cents per kilowatt in round one, reducing by the time round four ticked around to 61 cents per kilowatt hour. We can move to the next slide, Neil. So just looking at the legal considerations themselves, the contractual considerations, this is an extract from the refinancing clause in rounds 1 to 3. I think this also applies to round 3.5. And it says in the first part that sellers may undertake refinancings during the IA term, as long as they don't increase the quantum and the tenor of the debt. If IPPs do such a refinancing, they can do so as long as they give written notice to the DMRE not more than 3 business days before the refinancing is concluded of certain items, for example, the amount of debt at the date, the amount of accrued and unpaid interest, etc. And then not more than 3 days after, they need to provide the IPP office with certain information. So a very permissive clause in a sense, as long as you don't increase the quantum and the tenor of the debt. So I would have thought that refinancings that fall into that category may not need to have as stringent a set of rules applied to them. Neil, we can move to the next slide. In round 4, there is an additional clause that is in the IAs to do with refinancing, and that is really a consent requirement. So DMRE must provide its consent, and it may overlay conditions to granting its consent. We can move to the next slide, Neil. This really is just an extract from the clause on consequences on termination for government default, which speaks to the contingent liabilities of government. So where there's a government default, the DMRE is on the hook to pay the amount of debt and expected equity value, less certain amounts. Next slide. When looking at the finance documents and just considering the changes that a refinancing might make, we look at clauses regarding break costs. So to the extent that a refinancing is about to be triggered, to get out of your existing loans, often you would need to pay some kind of breakage cost. There would also be hedge breaks. And Dan and Elsa both alluded to the idea that in this period with COVID-19, markets have moved quite substantially, and those hedge break costs might be quite expensive. There might also be prepayment penalties in respect of your original loans. Certain IPPs have export credit agency cover on existing loans, and to the extent that they refinance those loans, the export credit agency cover might be lost. So that would be a consideration for some IPPs. And then I think quite an important consideration is to the extent that there's a tariff reduction, that may then impact on the dividend flow to BEE parties. and PE parties will have financed their equity through the markets and doing certain borrowings, and this may impact on their ability to service their debt. And I think that's a very important consideration to bear in mind. Next slide. So the last legal consideration then is from a procurement perspective. The REIT projects were procured through a very detailed and deliberate process. The overriding principle is that a tariff reduction must be done on a voluntary basis, and the DMRE and the IPP Office have observed this. The IPP Office is facilitating Eskom and NERSA consent and approvals, which is great, and that will make the process more efficient. No public hearings will be required from NERSA in order to confirm revised tariffs. There won't be the requirement for Section 66 and Section 70 PFMA approvals if one doesn't increase the contingent liabilities of government. And then finally, I make a reference to the refinancing protocol, which creates clarity across the market around what is required for the refinancings. Next slide, Neil. So this is my final slide, the conclusions. Just to say that most of the drivers for refinancing will be commercial, but there are a couple of legal considerations to bear in mind. But among the commercial considerations will be, do the benefits outweigh the costs? Very simple equation. Is there more to be gained through running new procurement processes and unlocking a much lower price than gains in rounds 1, 2, and 3? That might only be marginal. And I say that as a lawyer without really insight into how deep the gains can be in the round 1, 2, and 3 projects. And then from a legal perspective, we've spoken about the tariff reductions needing to be done on a voluntary basis, which is the premise of the IPP Office's protocol. And then second of all, just observance of the detailed and deliberate process that through which the IPPs have been procured, and observing the refinancing clauses in the implementation agreements. Thank you very much.
Thank you so much, Jason. Next up, ladies and gentlemen, we're going to put some questions up for you to answer. So please engage, please answer the questions. They're going to come up on your screen now. I'm going to give you a minute or two to complete them. You should see them now, so please get involved. Can you see? There we go. Just to let you know, we've still got the 222 people on the call with us, which is great. So the speakers, you guys are doing a good job. You're keeping everybody engaged, which is really cool. Well done. So no pressure, Mark. No pressure. Okay, I'm going to give you a few more seconds just to complete. We're almost up to 50% completion rate. And then I'll share the results with you. Okay, in 5 seconds. 4, 3, 2, 1, and let's see if we get 1 or 2 more in. Okay, that's it. Great, great guys. And Pauline, I'm going to share the results with you now. Then you should see the results on your screen. It'll make for very interesting reading. As I mentioned earlier, we will share the presentations and the full recording of this webinar session with you after the session, and it should go out later today. But next up, I'm going to stop sharing the results now. Hopefully you've got it. And next up, ladies and gentlemen, I'd like to introduce Mark van Wyk. He's the head unlisted investments at Mergence. Over to you, Mark.
Great, thanks, Neil. Thanks everybody, to my fellow panelists for laying the foundation. So I'm not going to go into detail with regard to the refinancing program per se. Just maybe we're going to touch briefly on the market changes and then also just from an institutional investor perspective, look at the performance risk analysis as to how we will potentially be approaching this. And I think our counterparties in the market would probably think of it the same way. So I think, next slide, please, Anil. So as an institutional investor into this subsector, and having been very early on involved in the subsector in round one, we've been fortunate enough in terms of seeing as to how this market has developed over a period of time. So we just got a couple of metrics that we've listed there, looking at, you know, the successive rounds and different technologies, you know, across all those different metrics as to how the market has changed as the overall market has seemed to have found a level of comfort with regard to the renewable energy independent power producer program, which has been successfully run by the DOE's offices. And also, I think the existing operational assets, their performance, the payments by Eskom, just constantly give the market more comfort that this is an interesting subsector of the market, especially on the credit side and also supposedly on the infrastructure equity side, that should be considered for investment by long-term institutional investors. And so from our perspective, we mainly represent investors from the pension fund sector. So we're trying to make a market for pension fund investors to participate successfully into this subsegment of the market relative to other opportunity sets that they can invest their long-term funding in. So the top line, basically just look at, you see the margin compression, and we try to keep it simple. And so we can see from 400 plus spreads over JIBAR, also potentially in majority cases hedged out for at least 7-8 years, spreads from 400 to 265, which is impressive. We can see also on the other side, gearing levels have increased quite significantly from 70% debt, sometimes now to 85% senior debt. The tenor of the debt is increased as well, which potentially exposes us as senior investors potentially to some more risk. But as I said, as we get more comfort, we're comfortable with living with a shorter tail towards the end of the life of the project. A key component, obviously, with the evidence that of the performing assets and the actual on-site measurements will give us more comfort on is the resource risk. Round one, we were all very conservative in terms of resource. We banked all these projects on the P90 basis. Successive rounds, we're still very concerned on the wind side, but on the solar side, I think the market has shifted majority to a P50 basis on the senior debt lend basis. And I think going forward, that will probably be consistent both for wind and solar going forward, but we have to look at specifically as to how each underlying project actually perform. And then also, a big concern for us as institutional investors is that we long-term investors, and we somewhat skeptical of investing into covenant light investments. What we've tended to see historically when projects or corporates come to the institutional investor market outside the banking sector, there's always this emphasis of going covenant light. And I think as a sector, we've been active in trying to ensure that we protect the interests of our clients. So covenant light might potentially not be the route to go going forward, but it's also a supply and demand market. So there might be investors that are very keen on still participating on a covenant light basis. And so there's a number of, as you can see, a number of different factors that play in on the economics, as Daniel potentially mentioned earlier. We could be commercial drivers behind a refinancing decision. Suffice to say that, as institutional investors in the space, we're very supportive of this refinancing program, and we're very actively looking to be participating into it going forward. Next slide, please, Bill. So this is something that we've just, we're mapping this for ourselves across our portfolio of 14 renewable energy projects, and trying to see as to how the resource risk is really playing out across the different sectors. So I think we're hoping that going forward, we will see a much better representation of this going forward. Next slide, please. So an interesting factor is also this a reduction in terms of what's happening in the capital markets currently. In the long-term capital markets, we're seeing an increase in the bond yield rates going forward currently. So as in the institutional investors, we have to make a market also for our clients. Our clients have optionality in terms of where they invest their capital, and so whether we reposition our clients into renewable energy versus government bonds on a fixed rate basis, it needs to be comparable. Then also similarly to, on the short end of the curve, and provide for more optionality going forward. Maybe this is just, going forward, there will be more optionality to potential borrowers that will refinance now going. And allow for short-term investors to participate. And that's specifically money market funds that has now reached about 450 billion rand of liquid capital looking for opportunity sets in this market. So we see that there's a lot of capital looking for yield currently, and it doesn't necessarily mean that it's one solution, one product fit for all. And I think borrowers will have to consider all the different permutations, as Daniel mentioned earlier, that will give them the best financial, commercial outcome, and then also potentially provide them with the flexibility going forward. And then similarly, I think more importantly, equally important, is to make sure that the shared benefit by reduction of tariff does actually manifest itself, and that the program will continue to be rolling out going forward on the back of this very important initiative going forward. Thanks, Neil. I think that's all my slides.
Great. Thank you so much, Mark. I appreciate your time. And ladies and gentlemen, last but definitely not least, we've got Henny Hanekom. He's the financial manager of Noblesfontein Wind Farm. So over to you, Henny.
Thanks, Neil. Good afternoon, everyone. Thanks for the opportunity to contribute to the refinancing and dialogue. When I think about refinance from the IPP's perspective, I have this picture of an 18-year-old kid about to leave his parents' house into the big open world. The parents in this scenario being the lenders, of course, who invested really a lot of resources into their kids. Like parents, the lenders also have all these house rules that needs to be adhered to, not to mention all their appreciated, but sometimes unwanted extra care about our general well-being as IPPs. Don't get me wrong, it is great to live under your parents' roof. Some kids never leave. But life goes on, however. There comes a time to consider the next step. So why should the IPP take a next step to refinance? That is what I hope to unpack for you today. What opportunities and incentives does refinance hold for the IPPs? What risks and pitfalls will IPPs be facing in the outside world? What uncertainties and discomforts will make the IPP hesitant to leave the house? And how does a refinance step can be healthy for everyone's benefit? So when looking at what triggers the refinancing discourse, my fellow presenters already covered most of these points, but I would like to touch base on the overall reason that the IPP's risk has decreased. This is evident in the movement of the tariff reduction and the cost of debt over the bidding rounds. Operating projects also carry less risk, having eliminated the initial construction risk and also having more certainty on their fuel expectations, i.e. wind and solar resource. Equity return expectations over time also change for investors, providing some equity and debt restructuring within projects. So, what benefits and incentives does a refinance hold for an IPP? The most obvious incentive and essential goal is for IPP IPP to obtain a new loan that has improved terms compared to its current existing loan. This can be in the form of decreased financial costs, lower covenant requirements, change in repayment profile, etc. Any change in terms need to ultimately lead to the increase of the NPV value of the equity holder. Refinancing is also an opportunity for the IPP to revalue the project, providing updated IRR and NPV values that can also be used for possible equity transactions. Refinance will also update the project's credit rating that might create some room for future short-term refinancing opportunities. Another option is for IPP to consolidate its debt or the amount of lenders that is in the current loan syndicate. Better general borrow terms can also be reached, providing some relief on all the limitations and undertakings that the borrower currently has to adhere to. IPPs can also consider increasing their leveraging if they are looking to acquire some additional funding. Looking at the average gearing ratios of around 1 to 3 projects, one will note projects in general are already highly geared and there is not much room for additional debt. Green Cape report shows that senior and mezzanine debt on projects could possibly increase to 85%. So when going into project gearing, additional funding obtained through these increased debt gearing can be used for early redemptions of group-related debt. This is especially beneficial if the project can achieve a better refinance debt rate than what is being raised on the group level. Leveraging can also be used for CapEx purposes, although there's not much room for expansion within the project due to the ring fence and PPA limitations that the projects have to adhere to. As an alternative option, leveraging can be used for investment opportunities outside of the project, bearing in mind that the investment IRR must always exceed the cost of the leveraged finance debt in the project. So, and this is bringing us to the risk. And the pitfalls on the refinancing. Leveraging will put some strain on the project solvency requirements that might restrict equity distributions. More control will be carried over the debt instrument holder, and in general, a general increased credit rating could lead to a higher finance cost on the leveraged debt. This will also result in a less room for short-term finance opportunities. Selecting the right variable base rate for the project is important and will depend on the hedging and interest rate policies the project has adopted. For example, a CPI base rate can provide a nice natural hedge for an IPP, but has a different repayment profile to a JIBAR rate. An IPP need to carefully consider between these two options to still meet the equity holders' distribution expectations and not to exceed the IPP Office contingent liability curve. Next, we have forecasting, which is always a business risk. IPPs will have to carefully consider the macroeconomic and the project-related assumptions that will be built into the financing modules. And moving from the uncertainties of the forecasting to a certainty that we can always count on, and that's being tax. Interest on leveraged debt could be deemed non-deductible in accordance with Section 23M and N. And even if leveraging is not applied and just a standard refinancing occurs, the project will lose a bit of its finance cost tax shield. Certain refinancing transactions fees could also be considered non-deductible for tax purposes. So if we consider all the refinancing transaction fees, there's a big component of overall refinance leakage. These fees include both debt financing fees and general advisory and consulting fees. Loan breakage cost, also known as early redemption costs, will likely be the biggest leakage component in the refinancing process. But this can be avoided when refinancing occurs with the current borrower's lending group. Although not an immediate leakage, the government share is in the form of the tariff reduction will also be a deferred leakage over the PPA period of the project. So if we can go to an illustrative example, let's consider these two bars as being the total project value. Currently, we'll need to note that the total value remains fairly static due to the nature of these projects and the finite terms of the PPA. The project value split between debt and equity holders, with so on the second bar, we are moving into a refinance scenario where the refinance lender will have a smaller stake in the total project value compared to its predecessor, this being due to the reduction in the finance cost. In turn, some additional refinance value in green is generated to the current equity holder, but bearing in mind a portion of this will be attributed to refinance cost. The tariff reduction on the far right end is not necessarily part of the refinance cost, but is more a mechanism that is decreasing the overall project value. We can make this a bit more complicated going into a leverage debt scenario, where if we go to the third bar, Neil, we will see that a portion of the current equity holding is now being, of the future expected cash flow generated from, to be generated from the equity holding is now going to be cashed in through the leverage cash flows. We have to note that in this scenario, additional refinance costs can also accumulate, and also the tariff portion can also increase. So bearing all of this in mind, there are still some general uncertainties and insecurities why IPPs are not jumping for this opportunity. The COVID-19 pandemic has put the market in a very volatile state that is not helping us a lot with decision-making processes. The IPP's office refinance process is also a big uncertainty, but also, and the new refinance protocol is going to clear that up for us. So, yeah, some projects also have some specific contractual and technical risks and might be hesitant to engage in refinancing process due to the fear of ending up with a higher general or credit risk. So, yeah, and the last reason is just purely the refinance market still being new and unestablished, which is also causing some reserve. So if I can go to my final remarks, I want to take the delegates back to the opening analogy. As industry, we should keep in mind why potentially it could be generally good and healthy for the IPP kids to leave their parents' house. That through our collaboration as an industry on the refinancing initiative, we could establish a new market, unlock additional value within the IPPs, attract local and foreign investment opportunities, and ultimately provide a cheaper energy resource for the end consumer. Thank you everyone for this opportunity and your time.
Thank you, Annie. Well done. Not easy being the last speaker, eh? Never is. Ladies and gentlemen, we're going now to question and answers. That's going to be hosted by Natombi. So what she's done is she's looked at certain questions that have come through, and she'll pose those questions to the panelists now. Over to you, Natombi.
Thank you, Neil, and thank you to our panelists for very insightful presentations. We are practically out of our time, so I'm going to request participants to please bear with us if we can take an extra 10 minutes to go through a Q&A with the panelists. And panelists, if you can please just keep your answers as brief as possible, maximum 2 minutes, and then we can get the questions done in the next 10 minutes. I will start with Daniel, because there's less questions for you. There's a question from Sizise Nzenze, who's asking, how did you calculate or address the key smart distribution drivers, that is IRR, NPV, life cycle costing, etc.?
Sure, I'll answer that relatively quickly. The best place to find the answer to that is in the new protocol document that the IPP Office issued today, which sets it out quite clearly in how NPVs and IRRs are calculated. But in short, you take the future stream of cash flows due to the shareholders based on the updated model, which has updated assumptions in it. You then discount those at the appropriate discount rate, which I've gone through the protocol document, seems to be the IRR of the project's base case financial model close. and then you do that pre and post the refinancing to see what the NPV benefit is. I'm keeping the answer short, but there's more detail in that protocol document for that can be read and understood. It's not particularly complex.
Okay. I'm gonna get to Elsa. I've got a couple of questions for Elsa. The one question is, can we expect, this is from Rofiwa Takalani, can we expect more or ongoing refinancing rounds in the future? And the other question is, could you please clarify if there is any contemplation from ESCOM, DOE or IPP Office to extend the current PPA periods to allow for longer tenures beyond the current terms? Over to you, Elsa.
Okay, thank you, Ntombi. Let me take the first question. Basically, the extension of tenors, of the PPA tenors, is not contemplated as part of this process, as part of the refinancing. And then in terms of your first question, the refinancing of projects is a natural outflow in terms of how projects move through their lifespan. And as such, this initiative is specific to bid window 1 to 3.5, but going forward, it is enabled in the project documents, and it will be enabled also in new procurements. But the guideline is basically exactly that. It's a guideline of how refinancings in future should also be contemplated. But obviously, the refinancing, the guideline can also be changed as we move and circumstances require it. But for purposes of this specific initiative, there is some timelines. But in general, refinancing will be enabled.
All right, thank you, Elsa. I've got a couple of questions for Mark. Also, if you can just keep it brief. A question from Karen Breitenberg. Mark, how do you see the risk of refinancing versus your last comment regarding the RIP to continue? Also, is most institutional investors not already involved in the program? So just hold on. I've got another one in the chat from Alistair Campbell, who's asking, given how much variation there was on your slide showing the performance of wind projects in relation to P50, P90 and P99, do you still believe that it is a good idea to lend to wind projects on a P50 base case instead of traditional base case being based on P90? Over to you, Mark.
Thanks. I think my learned colleague, Mr. Campbell, knows the answer about that one. I think, yeah, the evidence is showing that the wind projects, at least in our portfolio, is not performing as well as expected. And so, you know, and I said in the presentation, the historical performance will give us insight in terms of how we will model going forward. So I doubt as to whether we will be in a position to go down to P50 level on the base case for wind projects, but we'll have to assess it on a case-by-case basis as well. Then just to answer Corinne Breitenbach's question with regard to the refinancing in the future of the REAP program, yeah, I think yes, it is important that the market needs to be exposed to the projects on a more regular basis. The market becomes more comfortable. The different market participants also comes into the play. I think what we've seen, I think the second question alluded to the fact that there's a number of institutional investors already involved in the space. We haven't really seen that much. Well, we've got some pension funds having exposure, yeah. We've got a potential handful of the long-term insurers also participating. And then we've got this massive collective investment schemes pocket of capital having selective exposure into this market. And I think, that is probably the most fluid, most liquid market to be accessed for the most competitive sources of capital needed to kind of make this program more competitive going forward. So there is there is still a number of counterparties sitting on the sideline watching in. And I think the refinancing program will just allow for that momentum and the market making to happen again, attracting some of those participants into the market going forward.
Thank you, Mark. Question for Jason. What is the consideration on regularization of market arbitrage?
And Tommy, I'm not really clear what that question is getting at and precisely what arbitrage the ask of the question is referring to. So unfortunately, I don't have a ready answer for that one. Sorry. Any of the other panelists perhaps venture an answer to that one?
All right. Last question, if Neil, you allow me. There's a question to Daniel. As you correctly point out, this is from Prabhashan Govender. As you correctly point out, in order to respect the existing overall debt or equity contingent liability, shareholders will or may need to consider relinquishing part of the termination payment to lenders. Do you see such an arrangement being embedded in the implementation agreement in the refi scenario, or a bilateral arrangement between lenders and shareholders?
My view, I'd be interested at Jason's as well, is that it would be a bilateral arrangement between the lenders and the project company and its shareholders. I don't think that it necessitates a rework of the IA. I think it's unnecessary, and I think it's overly complex to have to do so. I see Elsa nodding, so I guess she tends to agree with me. But yeah, so I think that's the way it would most likely be done.
Yeah, I agree with you as well, Daniel.
I do agree.
Okay, Nyasha Horonga is asking, what is the potential implications should the affected IPPs opt not to refinance? Could this affect the future IPPs in South Africa? I suppose this is for Elsa, if I'm not putting you on the spot.
Ntombi, yeah, I think as we've said at the beginning, it's a voluntary process, and it's basically also per project, and obviously the performance of a project drives your readiness to refi, etc., and also circumstances in the market, etc. But if I have to answer it from the point of view of a country view, I would say that there is a responsibility on each of the participants to look at how best they can contribute to reducing the cost into the economy. I mean, this current scenario where we have high electricity prices impacting the economy, and it's on everybody to participate. But obviously, it is a voluntary process, and it is per project.
You're muted, Ntombi.
Sorry. Thanks very much, and thanks to all panelists and all participants who have stuck with us up to now. I see we're starting to lose participants and we need to wrap up. Thank you for engaging with our content, and thank you so much to our speakers. I do apologize for the questions that we didn't get through. We'll try and answer them through our social media platforms. I would also just like to thank our sponsor, RMB, for supporting the Windaba webinar series. Thank you very much for your support, and I will hand back to Neil to wrap up.
Super. Thank you, everybody, for all of your efforts. To the speakers, I thought it was a really engaging session, and the fact that we've still got almost 200 people joining us is testament to the fact that you guys have delivered on the topic today. I think it was very interesting, and then please look out for the next webinar that we're going to be hosting as we lead up to Windaba this year. And again, thank you to our sponsors, RMB, and we'll see you soon. Stay safe, everybody. Thank you so much.
Thank you.
Thank you, Neil. Thank you, everyone.
Thanks,
yes, thanks,
guys.
everybody. Much appreciated.
Thank you, everyone.
Thank you. Thanks,
Cheers,
Neil. Thank you,
guys.
everyone. Bye.
Bye, everybody.
Bye-bye. Ciao. Bye-bye.